Thank you very much. It's a great pleasure to be here today. I am here, we present our annual housing forecast and unveil it in October. I guess we're at the 1st of November now, but you're among the first to get to see the annual housing forecast. And I have to give a big thanks to the Kansas Association of Realtors and all of the different realtor boards across the state. We've had a partnership now for a little over 10 years, and that includes the Sunflower Association of Realtors, which you here in the Emporia area are a part of that realtor board. And it's through that partnership that we're able to provide local multiple listing service statistics that are available for you to be able to analyze and understand your local housing market better. But then we at the Center for Real Estate are also able to access those statistics as a result, which allows us to do this annual housing forecast. So we're very grateful for that partnership. I'll point out here the publication that's at your tables. This is an annual housing outlook that we do for 22 different counties across the state. And you can access all of these county housing market outlooks on our website at wichita.edu/real estate. And while you're there, you can also look at the PowerPoint slides from today's presentation if you're interested in those. So with that, when I begin doing the annual housing forecast, I always start with two fundamentals to say what will happen in housing markets in the coming year. And one of those is the labor market. And as everybody here today has talked, it's a really, really strong labor market with low unemployment rates and with rising wage pressures. And the biggest limitation we have is population limitations that are keeping us from growing jobs as quickly as we could, given the demand that there is by employers. So that's a very healthy fundamental for housing markets. The second fundamental that I look at are mortgage markets. What's happening with mortgage rates? What does it cost me if I want to buy a house? And how available is mortgage finance? And the answer in that regard is those fundamentals are also extremely favorable for housing markets. If you were at this conference a year ago, you would have heard me talk about mortgage rates. We've been on a steady upward trek with mortgage rates, and I said, this is finally the year that mortgage rates will go up above 6% and get us back into what I thought would be normal levels. And as they are wont to do, whenever we as economists make bold predictions, the data decide to do something completely the opposite. And since then, we've seen 30-year fixed mortgage rate has dropped a full percentage point compared to where it was last year, even after a slight uptick in the last couple of weeks. And you'll notice on this chart, the yellow line is the Mortgage Bankers Association's forecast for the 30-year fixed mortgage rate through the end of 2021. And whereas in the past, for about 6 years, they've been forecasting rates will go up, rates will go up, rates will go up. They are now at a place where they have thrown in the towel as well, and they've said, we don't know. They're forecasting rates to stay below 4% through the end of, not next year, but the year after that. From a housing market standpoint, that's really favorable for those of us who want to go out and borrow money, so it certainly isn't a negative thing. I would also mention that mortgage underwriting standards are as easy now as they have been at any time since prior to the onset of the Great Recession. And so, for the most part, anybody who is reasonably qualified can get access to a mortgage at incredibly low rates. So, both of these things, the fundamentals, are really, really solid. I'll just make a side note here. The theme, we always try and do a theme in our forecast, even if it's not as tied to my presentation as Jeremy's is. This year we wanted to do kind of a historic look back, and so I love the maps. You'll notice the map in your publication is the old Sanborn map for Emporia. But this photo that's on this slide comes from Wichita. It's actually an aircraft worker during World War II, and she's working at Cessna. And you'll notice that she's putting on some lipstick there. She's actually doing that next to some sheet metal there on the factory floor. And so I just thought that was a really, really cool picture, and I really enjoyed that one. And I hope you enjoy some of the photos and things that we have in here as well. The thing that I wanted to mention about these fundamentals is that while they're really, really strong, and our forecast is predicated on these strong fundamentals, everything could change at a moment's notice. In some ways, it feels right now like there's more uncertainty. For as much stability as there is, there's more uncertainty in going forward than there has been in a long time. And so if something fundamental changes in labor markets or in the financial markets, that could have a big impact on what we see in housing markets going forward. But absent that, you'll see that our forecast for the state of Kansas and all of the markets across the state is really pretty simple. More of the same. What we've been seeing recently is what we'll continue to see going forward. And so what have we been seeing recently? Well, this chart shows total home sales across the state of Kansas, all of the multiple listing services combined into one grouping. And the maroon bars are the monthly sales. And you'll notice there's a lot of seasonality there, right? Home sales go up in the spring, they fall off in the summer, in the fall and winter. And so the yellow line on here is a moving average that gives us a sense of what's the underlying trend over time. And you'll notice that starting in 2011, we had home sales activity begin to increase at a steady, healthy clip. Over the last year and a half or so, however, home sales have begun to tail off. They're not declining at a sharp rate, but they've leveled off, maybe declined ever so slightly. And the challenge here is that even though demand is really, really strong, again, we've got really great fundamentals, the inventories are very limited. And I'll show that and talk about that more in a moment. But the reason home sales activity has tailed off is not because of a lack of demand. It's because of a limited supply of homes available for sale. Now this chart shows Emporia area home sales, and I thought you'd like to see a comparison with how the Emporia area is doing compared to the state as a whole. And what you can see is that while starting in 2010, 2011, there was some healthy increase. We've now sort of leveled out. In 2017 and 18, we're down a little bit. We're not growing at a very fast clip, but we're not declining. So it's a similar story to what we're seeing across the state in large markets. And so our forecast for home sales activity across the state, as I said, is more of the same. We're forecasting that home sales will decline ever so slightly this year, maybe a slight increase next year, but essentially we see this as flat home sales activity, once again, because of limited inventories. And so the way that we measure these inventories is through a number that we call months supply. This really measures the balance in the housing market. So imagine if we had 1,000 homes that were available for sale on the market at a given time, and 200 homes on average were selling every single month. Then 1,000 divided by 200, we'd say there's a 5 months supply of homes available for sale. And typically we think that an inventory level, a month's supply of between 4 and 6 months is consistent with a balanced market. If the inventories are much higher, then there's a lot of inventory out there, and it really may be leaning more towards a buyer's market. If the inventories get much lower, it's hard for buyers to find what they want. Maybe that's consistent with a seller's market. And what you'll notice here is that both for the state of Kansas as a whole and for the Emporia area, the month's supply is incredibly low, sitting around a 3-month supply of homes available for sale. That's a very, very tight inventory. Now, it's important to recognize, however, that not every home is the average home in a market, and there are sub-markets within every community. And so to get to that idea, I thought I'd segment the Emporia market by looking at different price ranges. And these price points are entirely arbitrary. I just kind of looked at your data and said kind of what appears to be the lower end of the market, the middle of the market, upper middle, and the top of the market. And so my break points that I used here were list prices below $100,000, list prices between 100 and 175,000, between 175 and 200,000, and then list prices above 250,000. And what you'll notice from these different segments of the market is that for those lower three segments, inventories are pretty tight across the board, with the tightest inventories in those lowest price points below 100,000. But once you get to the upper end of the market, there's a lot of variability because it's a much thinner segment of the market. But above 250,000 right now, month supply is actually up in the 8 to 10 month supply range, so much more flush. And what that means is, as a home seller, even though you hear all the talk about, oh, it's a seller's market and there are bidding wars for all these homes, that depends on where your home is, what your neighborhood is, what price range it's in, and what condition it's in when it goes on the market. And this is one of the reasons why when I talk with students, when I talk with community groups and so forth, I always say it's really important to not just look, especially at the national media. There's no such thing as the average U.S. home. So when we talk about the national housing market, it's a totally meaningless concept. It's also meaningless to talk about the Kansas housing market. Even within Emporia, you own a home in a neighborhood, in a particular location within that neighborhood. And so really understanding the local conditions and working with a professional that can help you with that has a lot of value. So, strong demand, tight inventories, we would expect to see home price appreciation be pretty healthy, and that is in fact what we're seeing. Now, as a good measure, Kelly here mentioned earlier that I was going to say median sale price isn't a great measure of home price appreciation. This instead, the number that we have right here, is a home price appreciation measure that's released by the Federal Housing Finance Agency, where they're really trying to measure quality control. Same house, how much did the average home price appreciate? And we have that for Kansas, for all of the metropolitan areas in Kansas, but at the non-metropolitan areas, we only have an amalgam of those non-metro counties across Kansas, of which Lyon is one of those counties. And so it's a good measure of overall home price appreciation, but it's not necessarily as local as we'd like it to be. It lumps in southeast Kansas with northwest, southwest, north central Kansas. But it still tells an interesting story. And the story here, you'll notice, is that as we go back to the Great Recession and the downturn that we had in the housing market, nationwide, we had some pretty steep year-over-year percentage losses in the housing market for home price appreciation. Nationwide, we had 2 or 3 years there where we had home price declines of more than 5% per year. That was pretty strong declines. You look at Kansas, our home price declines were much less steep than they were nationwide. But the gold line there is the non-metropolitan areas across the state, including Lyon County. And what you'll see is that actually through a lot of that downturn in the nationwide housing market, home prices in the non-metropolitan areas continued to rise. Not very fast, but they didn't fall. Since then, home price appreciation has been much stronger for the U.S. as a whole and for the state of Kansas, whereas the non-metro areas have stabled out at about 2.5% home price appreciation per year. Now, again, that measure is not necessarily exactly reflective of Lyon County, and so I will look at median sale prices. And again, that's not a perfect measure. What is the median sale price? It's the price at which half of the homes sold for more and half of the homes sold for less. Now, over a long period of time, that's actually pretty consistent with genuine appreciation of individual houses. But over short periods of time, it can be impacted by which segment of the housing market is selling more. If we have really, really strong market in the lower end of the lower price points, that could cause the median sale price to fall, even though every individual home value is going up. But nonetheless, it gives us some sense of home price appreciation in the Emporia area. And what you can see here is that we've really gone from a median sale price that back in 2011 and 2012 was typically in the $75,000 range, where now it's up now above $100,000 pretty consistently. And so that's pretty healthy appreciation over this long period of time, very consistent with that idea of the tighter housing markets and strong fundamentals that we've seen. Our forecast for home price appreciation across the state is for home prices to continue to accelerate at a reasonably healthy clip. 6.2% is incredibly strong for Kansas. We don't see that as sustainable, but we think we'll end this year with home prices growing by about 5.2%. And even the 4.4% gain for next year is a very, very strong home price appreciation rate for the state of Kansas. Now, the last thing that we forecast is new home construction activity. And you might think that if you've got strong demand, limited inventory, strong home price appreciation, that we would see a lot of new home construction activity across the state. But as you can see here, our forecast once again is more of the same. We're still just bouncing around, 4,900, 5,400 units, really not very strong new home construction activity, even in the Kansas City market. Why? Why aren't we seeing builders come into the market and say, let's add to this inventory? There are such shortages. Well, the problem is that in the price ranges that are in greatest demand, it's really hard for home builders to build any inventory, to build product that's competitive with what little inventory there is available in the existing home market. Even during these years when home prices were falling or just flat here for 2010 through 2013, all through that period of time, construction costs, both labor and materials, continued to go up. And even as existing home prices have risen at faster paces, construction costs continue to rise at an even faster rate. And so until we see some really extended increases in existing home prices, it's hard to see how new home construction is really going to return to some of the higher levels that we've seen, even despite the shortage that we have. One of the things that I think is kind of interesting is as we've gone around the state over the past 10 years, this need of being able to build new housing in smaller communities has always been challenging because of the difference between the cost to build and what the underlying housing stock is worth after it's built. We're seeing that same problem now in the larger metro areas across the state. Is you just can't build in Kansas City a $250,000 house, which would be right in that sweet spot price point. You can't build it and have it be anything comparable to what $250,000 homes in the existing home market. So that is our forecast. You can see the summary of the forecast. I actually have copies of all of the large market forecast publications on the table over here to the side, and you're welcome to pick up copies of those. And you can access all of our forecasts, all of our Outlook publications, and today's presentation on the Center for Real Estate website at wichita.edu/real estate. And with that, I think I have a moment or two to answer questions if you have any. Yes?
What's the average length of time somebody's in a house at this point in time?
I don't have that number for Emporia on the top of my head. Can I go out here and can you say what's typical days on market right now in Emporia market? 160?
How long do you live
Under 60 days. Oh, tenure, time that people live in a house.
Before they make a change.
Nationwide, that often is between 5 and 10 years. We typically see that as being the normal time for people changing. But I don't have those numbers off the top of my head for mine.
Even nationwide, is that different? Would that cost that would cost a different in our
Certainly,
supply.
the more frequently people change their housing, that just creates demand for churn and turning over. There is anecdotally, at least, when you talk with realtors, one of the ways that buyers, one of the questions I ask, when I do this housing forecast, I go and I do round tables in August where I talk with realtors. I see the numbers, but they're dealing with buyers and sellers on a regular basis. And I ask, how are the buyers responding to these really tight inventories? Are they acting like it's a seller's market? And one of the ways that I'd expect them to respond would be to maybe change their expectations. I'm not gonna buy that HGTV home, and instead, I'm going to find the fixer-upper and get some sweat equity. It's what all of us used to do, right? You'd find the home that had some good bones, and you'd build it up, and you'd take that. We're not seeing that happen as often. They're just waiting. There are people who are more inclined to rent and just stay in a rental market. And we're also seeing that there's a lot more remodeling activity. So somebody might like to be in a move-up market, but they can't find what they want. And ultimately they decide, wow, these rates are so low, let's just go ahead and add an addition to our house. And so you're seeing a lot of that type of activity as well. Yes, Becca?
So this is just a quick question, and I don't know anything about this particular market here.
Mm-hmm.
But in Portland, Oregon, we saw a huge mass of people buying cheap housing and turning that into like Airbnb or other short-term rentals.
Yeah.
Is that something that you're seeing happening in Kansas or in our rural areas here?
So the question is, do we see some sort of almost corporatization of Airbnb type activity in Kansas broadly? And certainly there are investors out there who are doing it on an individual basis. We're not seeing the mass investors doing that in Kansas. I won't speak to Kansas City. There could be a lot more of that. But you do see, individual investors who are doing that type of activity. And instead of looking for long-term rentals where they want a year-long lease, they're thinking about it from a standpoint of Airbnb type things. I don't think that's playing as big of a role in our limited inventories as people perceive. I think it really is just an issue that we haven't been building for a number of years to be able to keep up with housing stock that eventually housing stock needs to go out of the housing stock. Jack DeBoer, real estate developer in apartments and now founder of Residence Inn, he was famous one time for saying, in the apartment industry, we're not overbuilt, we're under demolished. And right now what's happening is we're still seeing some of those demolishments or the abandonments happening, but we're not seeing the homes being built to replace them. And quite frankly, a lot of those really, an 800 square foot home, that's the kind of home that Jack DeBoer grew up in, those homes just nobody who's buying a new home is interested in that home, regardless of the income range. It's really hard. You're not even seeing Habitat for Humanity, for instance, building homes at that same kind of 2-bedroom, 1-bath, 800 square foot home. So modernizing the housing stock is a challenge when cost of construction is so high.
13.3 years average, median term.
13.3 years. Wow, that's a little longer than I would have expected here. Is that for Emporia or for United States as a whole? A little longer than I expected, and that has gone up a little bit from where it had been in past years. Yes?
So we have lots of small communities that are struggling with not having workers.
Yeah.
And one of the main issues, stumbling blocks, is homes that are affordable in the wage bracket that they're trying to recruit.
Mm-hmm.
And so they're looking at getting these investment groups together, right, that are gonna build these, little developments to try to attract. So what kind of impact does that have on the market?
Yeah, the challenge that you have with these things is that it might cost you to build the house that you really think these workers want.
Right.
May cost you $120,000, $150,000, but then in the resale market, that house may only be worth $100,000. I mean, there's this disconnect between the cost of construction and what people are willing to pay. And unfortunately, in economics, when the supply curve and the demand curve don't cross, it's really hard to make a market. And so, this has been a challenge that we've had. And people have asked me about it for 20 years since I've been at Wichita State. And if I had a miracle answer to it, I think I would be winning a Nobel Prize.
Is the state looking at this as an economic development issue and trying to come up with some, incentives or other things that would help bridge that gap? Because
there are people in the state of Kansas and there are people in communities all across the state that are continue to look at this thing. Lots of task forces set up, and you think of all the money that's put together, of all the people on task forces and their time that's spent. But in some ways, that disconnect of cost, ultimately it takes just a lot of money to make up that difference, and that there's not a silver bullet to fix that. Well, I think this means my time is up, so I thank you all very, very much. You all have a wonderful day, and I'm happy to stay around for more questions.